As anniversaries go, this is one of the most painful anniversaries to remember. It's been a year already since the domestic debt exchange. Many of us were hit hard. And as you know, it's been one of those challenging periods for people who invest. The investment community, investor community have taken a big hit. It's been 1 year, but what has been its impact? There's a reason why the government wanted to do this. The economy was on its knees. The debt stock was ballooning. We were going to the IMF. We had to bring our debt back into check. And so we headed for something that we've never done before, the domestic debt exchange. So have we achieved the objectives that we set for ourselves as a country when we embarked on this and inflicted pain on pensioners, on the middle class? And there was a fear that was expressed by the majority leader, Chairman Sabongsu, and this DDEP was going to wipe out the middle class. Okay, so we're going to look, those fears that were expressed at the beginning of the process, have they materialized? We are all wiser now looking back. Many did not participate, but many still did participate. So first of all, the objectives that have been achieved. The fears that we expressed at the beginning of this, have they materialized? And if not, okay, where do we go from here? But most importantly, how do we ensure we do not come back to this, right? And I'll show you at the end that in some countries, they went through this phase and they had to return to another form of DDEP. Let's remind you how we came to this point. The finance minister was clear that this has been successful. Has it been successful? We're going to look at the real numbers, and my guest is joining me to drill down. It is important because if we don't do an assessment of this, that's a problem with us. We always return to the fundamental problems that we deal with on a daily basis. Why? Because we do not take time to take stock. So we're going to do that today. And just so we refresh our memories a bit, as you may know, the DEP, the estimated cost was pretty severe. And we had the Treasury, the Treasury bonds, ESLA bonds going in there, estimated loss of some 12.4 billion, USD denominated local bonds, some 7.2 billion. The losses were all over the place. And cocoa bills also 4.5 billion. But the Bank of Ghana loss is the one that jumps at you because you see that unprecedented loss that the Bank of Ghana recorded. They blamed it on the domestic debt exchange. And you see the numbers here are pretty startling indeed. And you see the pensions had no haircut, but indeed they fought very hard. So this is not something that they had to bear. And you remember they're insistent that they wanted an exemption from this process, and they wanted a hard written signed document to back that, and they got that also. And the estimated gain to government loss to bondholders is some 60.8 billion. That's how much government had taken from our pockets over the period, indeed. And so this is no joke for people, and the people are going to have to bear this over time. And one of the things that we need to assess now, confidence in the market is one of those things that we need to assess tonight. Is the market about to recover? Can it ever recover? In the confidence that we had in government bonds, in going into the market and putting our monies that we've saved to invest, right? Is that back? Can it ever be regained? And we're going to look at that because for me, that is a very fundamental point indeed. And those who work in the financial sector, this really was a heartbreaking experience for them because people simply lost trust. Remember that we're coming on the back of the banking sector restructuring. Many people lost money there. We lost faith in the banking sector. And then through hard work, through a lot of restructuring that we saw, banks started regaining the confidence of people. And then the domestic debt exchange hit. And now, as you see here, if we look at the old bonds, at the time that we started this, the proposals were on the table. The old bonds were going to go for 19.1%, and I was holding one, and I was somewhere there. And then we're going to give us something in the region of 9.1%. And that started the protest. Here, we actually still have on the, when I said now I'll show you, the desk that I use to present PM Express. There's a significant crack in the glass that, decks that particular desk. You know why happened? What happened on that? My good friend, Senor Hosi, was here on this very matter when it was supposed that you're going to take this significant haircut, and he just could not control it. He hit his hands so firmly on the desk, it broke the glass. And that's how bad it was at the beginning. Let's just recall that. Indeed, it is one of those things that, an experience in our time that we will tell our children for a very long time to come indeed. Of course, then the pensioners also came in with theirs. Also theirs will, of course, stay the same, but they wanted a clear exemption there. We saw the U.S. Local bonds also had to be brought into the picture. With these figures there, everybody was going to take a bit of a cut there. And I remember at one point the fear was, if you don't put your money in, if you don't exchange, you are not unable to trade the old bonds. Was fear that we had. What was going to happen to your old bonds? Were they going to become useless? You may possibly lose your money. Government was not able to pay you. It was chaotic. But as we've seen, government has successfully paid the coupons over time. And the confidence is they will continue to pay. But that's another question we need to ask my guests when they join me. How confident are we the government can keep paying these coupons when they fall due, but also the coupons that mature, can they pay the principals? And that's a key point also that we'll explore just to see if that restores the confidence in the market. Look at the Bank of Ghana hit. The Bank of Ghana hit was quite significant indeed, and which, of course, for 15 years, they will have to work around how to get this back. But one of the things that also some civil society and the economists have said is that the government's target as against what was actually exchanged, if you look at the numbers, all of them was above 90%. But in terms of the real value, government didn't quite get what they wanted. And so they kept on coming back with different forms of the domestic debt exchange. Initially, as you know, the pension funds were not part of it, but they brought them into the picture also because they wanted to make up for their inability in the first round of DDEP to get exactly what they wanted, right? As you see there, the local bonds, the target was 109 million, they got 742 million. That's 91%. 91% is pretty high. But in terms of how radical they had to be to meet the IMF targets, we needed far more. Cocoa bills were also brought into the picture. 7.9 billion, they got this. But I wanted to pay attention to the Bank of Ghana one. The target was 70.9 billion. They got exactly that, 100%. That is why the Bank of Ghana say they took the bulk of the hit, so the economy will survive. Is that really the case? And if that's the case, how is the Bank of Ghana going to recover from this over time? This has been talked about quite a bit this year. If you look at the amount exchanged in all, 203.7 billion, that's a lot. That's 94%. But how is this good for us in terms of our debt stock? And that is the part that I want to take you to next. Because if you look at it, under the domestic debt exchange, we are so piling on debt. At the beginning of the domestic debt exchange, we're at 446.3 billion. That's the public debt, right? As of September, we are now at 567. So we've piled on 121 billion more debt. But the whole idea of the domestic debt exchange was to put us in a place where our debt is manageable. So what does this mean for us, by the way, and the effectiveness of the DDEP, considering the pain that people had to endure? And then you look at the public debt, the comparison in billions. Again, you look at the beginning, was that the domestic, debt exchange, shows you the picture there. Look at the private sector. The private sector is interesting because people just stopped. The banks, they stopped loaning money to people, and that's why you see the negative there. The banks they preferred rather short-term investments over extending the credit, and they were putting their money into the T-bills, which, by the way, we'll see the finance minister say it is that which they're going to be using to finance government expenditure going forward. And this is a very important point, that the residual net domestic financing will amount to what they call 61.4 billion, right? That represents some 99.3% of the total finance of the 2024, which is quite interesting. So what it means is that they're going to be sourcing from the issuance of debt at the short end of the domestic market. We're talking about treasury bills. So you can realistically expect that the treasury bill rates may not go down as much, right? Because where are the avenues for borrowing? It's closed. And again, another question we need to ask tonight, when can we realistically expect to go back to the markets? When can you expect that the government can issue bonds again that we can trust, that we can put our money in. I'm not talking about the bonds that we exchange. I'm not talking about that. I'm talking about bonds that are not related at all to this. And will you be confident enough to say, I'm going out there to buy government bonds? And what would that take to bring that confidence back? Those are big questions about the survival of the entire financial system going forward. But the Jamaica example has often been excited. They said they were successful when they first did the DDEP in 2010. But by the time that they were unable to deliver on the fiscal restraint, they had to go back to it 3 years down the line. It reached approximately 147% of GDP. I'm talking about that. And that is what we need to watch. The fact that we have done a year of DDEP doesn't mean that we are out of the woods just yet. And I need to ask that question when we sit for a conversation. The second DDEP in Jamaica was 2013 because it became absolutely necessary for them to return to it. How do we ensure that the pain that we've taken over the last 1 year does not return because some way, somehow, government, considering an election year, was not disciplined enough, and possibly in 2025, we should not be returning to this pain when another government takes over. That's a conversation we need to have. After the break, my guest will chip in. After a year of pain inflicted by the DDEP, tonight we take stock here on PM Express. Always brought to you by Syntex Tank. It is strong, it is tough. Alumobites experience greatness in every moment. Ghana AIDS Commission and Syntex Tank is the tank for you. It is the first to introduce the double layer tank, and now you can have as many layers as you want. Syntex Tank is first to introduce the white inner layer tanks in Ghana, and we now introduce you to the customer specs order. We'll let you order any color and size of preference. Syntex Tank gives you the longest warranty of 7 years, which no other tank gives you in Ghana. So whatever your water consumption, size of project or demand, choose Syntex Tanks. We have agents across the country. 0244-335-168. Shop online at syntexgh.com. Strong, tough. My guest joining me, Professor William Kwesi Pepra. He's Associate Professor of Finance at the Andrews University in Michigan. Thank you, sir, for joining us. Dr. Edwin Anoyinchi, I'm grateful that he can join us. He was really in the thick of it all. His group, the Pensioner Bondholders Forum, were really very vocal. They took a bit of the pain. They had to stand in the sun. They protested. A year on, what's the assessment of this period and the sacrifices that they've had to make? Are they confident that it's yielding the right results now and can sustain the economy going forward? I'm interested to hear his thoughts. Dr. Theophilus Champon is a political risk analyst and also joins us on this. And I want to start with you, Dr. Edu Ananiemchi. If you look back a year on, have the objectives been achieved? The objectives for which you have to stand in the sun and fight so hard, and your members took a lot of the hit, negotiating. And do you feel that it was worth it, looking back now a year on? Please unmute for me.
Yes, thank you very much so. It was a worthy fight or struggle, if you want it this way. If you look back, you realize that, yes, you had to do that, and whatever we achieved, that's what we set up our minds to do. That our focus was to get that total exemption, which I call issuer's exemption, and we got it. So for us, when we look back, it was a difficult thing. As for that, we went through what we ordinarily wouldn't have liked to go through. But it was worth going through such a situation to finally get our exemption. So let me say it was a good fight and worth fighting.
I mean, Dr. Champon, so the objectives for which Dr. Donanientri and his colleagues fought for which some of us took a hit, and others obviously did not because they didn't participate. Looking back at you on, have we achieved the objectives for which the government imposed the DDEP? Dr. Champon?
Yes, good evening. Yes, I think the objectives have been partly achieved. The the domestic debt exchange was just one of a series of interventions that the government had to make. So remember that we're still yet to finalize the external debt restructuring. But if you look at it as a story of two halves, and the first half being the domestic debt exchange, then largely you can actually see the improvements in some of the core debt indicators. So like in the 2024 budget, as of September this year, we're seeing the debt to GDP come down to about 66%. And then it's also created some room or fiscal room for the government to undertake some other sort of priority expenditures. If you look at it from that perspective, you could argue broadly at the macro level that some of the objectives have been achieved. And there's still more to be done on the external debt restructuring front to complete that. But of course, there's a trade-off, and the trade-off which people like the pensioners and the likes went on the street and protested really is that we've seen the economic growth or the recovery being relatively slower than we should have been expecting. We've seen, of course, the impact on the banking and the financial sector, and even on credit provision. So you look at paragraph 117 of page 29 of the budget, and the government says that, quote, that outstanding credit to private and public sectors declined sharply during the period under review due to increased risk aversion of banks, partly induced by the impact of the domestic debt exchange program on the bank's, balance sheet. So that is the trade-off that people have had to go with. But if you look at it broadly in terms of what the government set out to do, you can argue that on the DDEP front, yes, they have achieved that, but that would not be complete if you don't restructure and we get a deal very soon on the external debt front.
Okay, so stay with me. And Prof. Pipra, what's your take on that? Do you agree with that verdict, that the objectives have been achieved?
I mean, thank you very much, Evans, and good evening to your viewers. So, if you ask me, I see the DDEP was a condition precedent to IMF coming into Ghana. So that was the main objective. I'm sure the government itself wouldn't have liked to do that. But when the government accepted to place a call to IMF, they need to fulfill certain requirements. And one of them was to ensure that we have this domestic debt exchange program. So on that front, we've seen that, yes, indeed, it was done, and it has paved way for Ghana to receive the first tranche, which is the $600 million that came in. Then the second front for me that I've noticed is it caused a reduction in interest payment. So this is also very significant, as Dr. Teo mentioned. It reduced some cash flow burdens on the government. Then the third objective that I think government have benefited from this is also having the maturity period change from the data you presented. I mean, most of the instruments that were existing were going to be matured in 3.8 months, in 3 years and 8 months. And now it has been restructured to about 8 years.
Yeah.
So government will have that room. So from that angle to government, they have been able to achieve that. The flip side is that it has worsened situation for investors, especially domestic investors, because they have to give in to lose expected interest or income, and then they may have to also change their lifestyle. And this has not ended. A lot of investors are still weeping because of this particular issue. So, as far as government have had the benefit to get IMF to come in, the flip side is that investors are not very happy, and this has probably weakened the confidence in the financial sector. If you look at the banks themselves, the financial industry, most of them were not prepared, but their board, they were not, in terms of their financial planning or budget, it came as a shock to them because it happened. The call came around December, and they had to negotiate with the government to move it to the first quarter of 2022. So these issues became very, very challenging for the financial industry. We've noticed it is not only the central bank that brought in provision for losses, but we realized that a lot of the financial institutions also had to make in the provision and recognize their losses per the IFRS standard. So just to end it, yes, government probably have achieved their aim, getting IMF to come in, but it has brought in a lot of problems for investors. In Ghana, I'm just only looking at from the domestic debt exchange. External investors are having a discussion, and they are also going to have their own way of dealing with the issue.
And that fundamental question comes on the back of what both of you have said there. So you both agree the government had achieved the objectives. But Dr. Donald, at what cost?
Well, as for the cost, it will always be there. And I always say that maybe we could have reduced whatever costs that we have incurred now if the whole program has started with the right negotiation with all creditors. You recognize that government is negotiating with the foreign creditors. This is exactly what we should have done with local creditors. And I think if we have gone through that process and gone through it well, maybe the costs would have not been as much as we are having now. So that's also one key lesson that I think policymakers should take on board, so that next time when we are going through some of these things, we do the negotiations and do it well, let people understand what is happening, and you get a buy-in. When you get a buy-in, I think we would have moved faster than this. People were thinking that we're running very fast, leave a negotiation behind. But I tell people that yes, because you didn't negotiate from initially, you come back 2-3 times. You go, you come back, you go, you come back. But if you have negotiated, maybe if you have taken even 2 months to do the negotiation and finish with the negotiation, then you come in and you have the buy-in. You would have even moved faster than this, rather than forcing to move fast. Then you go and you come back, you go, you come back, you go, you come back, before you realize the time that you have spent going and coming back, if you would have used just a little less than half of that time to do the right negotiation, to avoid all these things that we went through, getting these elderly people to go and be picketing and all that, creating an image that is not good for all of us.
Yeah, I mean, and Dr. Tuichampo, the government have achieved their objectives. And when I asked about the cost, there's also a cost, as we've just heard there articulated by Professor Prepra. The cost to the financial sector, the cost to investor confidence, as where we are. What's your assessment of that? Is that the biggest cost yet to the DDEP?
Yeah, absolutely. I mean, it is a cost, and it's a cost that is going to take some time for the banks, the financial sector, and even other institutions to sort of make do on hitherto those interests and things that they were enjoying before. I remember that as we speak, even the proposed Financial Sector Stability Fund, I only read a few days ago that it's only just started.
Yep.
But again, that is just a fraction of what the banks and the financial institutions are required, in a way to make them whole, right? So there's still a lot of losses that a number of these banks are writing down on their books, and it would take probably a year or two before, you begin to see that begin to ripple to. But for me, I think the biggest thing really is on the issue of the availability of credit to the sector of the economy from sort of where I sit, that if you have this dumping confidence and banks are having to write off, these heavy losses on their books and all of that, ultimately you begin to feel it in terms of credit availability. And the government itself recognizes this in what I indicated, the budget. It's when that was read on paragraph 117, page 29, where they talk about risk aversion happening within the banks, but to the extent that it is now affecting both the public and the private sector. And if credit availability, or call it liquidity broadly, begins to hamper these, critical sectors, then ultimately you're going to suffer in terms of growth, in terms of spending, even overall livelihood. So that's one sort of bigger macro cost that one should take into account. But that's the pain or the trade-off that we should have or we did factor into the calculations. Quickly, I think yes, Williams also talked about the maturity extension, which is great. Just a little point there for me is that as you kick the can down the road, so if you look at like the first leg of the DDEP, the average maturity rightly is moved from 4 to about 8 years. But the debt will still be there. It's still compounding. You've been able to bring down the coupon rate. If you work out the numbers, it's all now contingent, importantly, your debt metrics, on how fast your economy is able to grow, and therefore the ability to bring your debt to GDP, debt to export, and all those things, down. And I think really the emphasis now going forward, post DDEP, and potentially with the restructuring of the external debt, is how do we grow this economy much faster in a way that creates jobs, sustainable jobs, in a way that reduces poverty and inequality, but ultimately,
I wonder, Doc, to what extent, on that point you make about growth, how has the DDEP impacted that and our ability to actually grow?
Oh, if you look at the projections that the government made, so you can go back to the 2023 original budget, the growth numbers, and the revisions that subsequently we had to do to bring them down. And at one point, we're projecting almost 2.83% or so growth for that was for last year. And then again this year, some of the numbers, you've seen a bit of an uptick, but it's still nowhere near the levels that pre-DDEP we were even projecting we would have grown. So clearly, you can see some hit on that front. But then the important thing, I think, going forward is being able to sustain, that growth. Because even with the case of your external debt restructuring, if you get there, what the Zambia example has shown us in the last few weeks is that you can have 2 or 3 different scenarios, but these are all dependent. Your debt servicing or debt carrying capacity is dependent on how fast your economy is able to grow. So in Zambia's case, if your economy doesn't grow as much as you want, you're going to pay about 1% interest up to 2036. If the economy picks up much better, you pay a lot more. It goes up to about 4% in that manner.
Okay, and Dr. Donanenja, I want you to... Yes, please.
Yeah, let me talk about the costs.
Okay.
So we noticed that it cost us to have a lot of projects hanging, uncompleted projects. One historical cost that is going to live a very long time with this current government and the party is the issue of haircut. It is an intangible cost that is going to brand the New Patriotic Party for taking this decision. This cost, if it's not managed very well, it is going to be a very big blow to them in the upcoming election. So it is something that it needs to be handled very, very well. Quantitatively, we can talk about the macro figures, but the qualitative cost to the party itself for taking this decision is something they must have to find a way to work around it. You remember in 2020, when the advice was given to the government to seek help or reduce their expenditure lifestyle, Pastor Bobkin talked about it, to slow down or reduce the expenditure for us to live within our means. We did not. So the consequence or the cost, it is not just only the quantitative cost we are talking about, but the qualitative cost that may live a very long time with the New Patriotic Party is going to be very detrimental. Now, everybody going to mention upon what political party that we heard the word haircut. So this cost is going to really be with them unless maybe another party comes and they find themselves in this kind of situation.
And that is a very important point. I want to bring in Dr. Nunanchu on that point. That question about haircut, that's why you fought so hard to get the government to give you the exemption. This is your area. What has this done to, and Thierry Champon started on this, and I want you to, because you used to be the former head of the SEC. What has this done to the securities market? I mean, and our confidence in that sector? Do you ever foresee a time when we will come back to the place where we trust government bonds? We were told they were risk-free. That is no more. Can that ever recover?
Well, let me first say a little thing about this haircut. I've said that maybe Ghana, we are using what I call technical knockout. And so we think all knockouts are knockouts. But technically, haircut is when you have lost part of your principal. You lend 1 million to government, and government says, I am hot. I can pay you only 800. Then it means your 200 is not coming. But in Ghana, we have taken haircut to be any loss of income, whether it's from even interest coupon, we call it haircut. So let's get that thing clear. Ghana has, I have said that I will call that technical haircut, not the ordinary haircut. But coming back to the issue of what is going to happen to the market, and I have always been saying that is the public confidence. The confidence in the market must be restored. We'll go through all this, just like capital market or stock market crash. Sometimes certain things will happen and the market will crash. But the market doesn't stay at that crash level forever. It picks up again. And you must ensure that you do what is needful to ensure that the market will pick up.
What must we do? What must we do?
Yes, and that is why when government wasn't paying the coupons, I kept on saying that after you have done this, you must try and ensure that you are paying coupons and principals when they are due, to enable people realize that, well, you went into a problem. Now you have come out of the problem and you are servicing your debt as and when it is due. That will help in restoring public confidence. But when you have done it and still you are unable to make the payment, then you are destroying the little confidence that is there. So now that government has started and is paying regularly the coupons and the principals that come up every day or every week, that will help in restoring the public confidence. But don't also forget that it is not only the government bonds market that people have challenges. These funds that are also locked up in the whole financial industry is a key thing that is affecting the total confidence of Ghanaians in the financial market, not only in government bonds, but in all financial market instruments. Because if people have invested their funds into all these savings and loans and finance houses, and they cannot get their money back, that is a key challenge to financial market stability. And I always say that when people are talking about that there's banking stability, if you say banking stability, fine. But if you tell me there's financial market stability, we don't have it. Okay. Once people's money are locked up in the same financial market, you can't say this market has stability. People should be able to go into this market and come out anytime they want. That is stability. You go in at the time you want, you come out at the time you want. But not when you have gone in and you can't come out because your money is locked up. And then people are just talking about financial stability. No, we wouldn't have financial stability until all these issues are resolved. So after the bonds, government bonds, the next thing that we have to do is to ensure that all these locked-up funds in the financial market are returned to investors. Then we can build back confidence in this market. Otherwise, all this talk about financial stability will be ruinous. We wouldn't have that stability because people still fear putting their money not only in the government bonds, but also in the other sectors of the financial industry.
But you're confident we can recover?
Yes, we can recover. Markets behave like that.
Okay, good.
If you look at the world stock market, there's crash. There's always crash. It comes, you crash, but you are able to come back.
Okay, good. I mean, I'm going to take a quick break. When I return, I need to assess this. One effect of the domestic debt exchange and government's inability to borrow and for us to lend to it is that they've gone to the short-term market. I mean, as I illustrated there, the finance minister, they're relying almost exclusively on the treasury bills. Is that sustainable going forward? And I want to get my panelists' thoughts on how sustainable that is. But most importantly, considering the pain that DDEP had inflicted, the gains that we have made over the last 1 year, as has been eloquently illustrated that we've achieved our objectives, will that sustain us going into 2025? And I want to look there because as we see in Jamaica and elsewhere, it's not the fact that you've succeeded in doing it once doesn't mean that you can necessarily say you are out of the woods. So I want to pick your thoughts when we return on that. And then finally, the fears that were expressed at the beginning of this whole DDEP. Last year by this time, pensioners were crying, individual bondholders were crying. There was almost the impending doom and gloom. Did it materialize? Were they all founded and justified? I mean, a year on, possibly, were we just being alarmists? Join me after this. And a year ago, by this time, government was just announcing that the DDEP was about to break out. It was about to be inflicted on us. And there was loud cries. Here in the studio, if you look closely, there's a significant crack in the glass here. It was inflicted on this particular desk by a good friend of mine who was on the show with the individual bondholders who were alarmed, outraged at even the prospect that they're going to lose part of the investment. They trusted the government, they gave the government the money, and our government says, I can't pay. And so you have to either take a haircut, and as we've explained with the Dr. Dodanenchi, at that time, we're going to take a haircut, for real. I mean, you're going to possibly lose part of your capital, you're going to extend it, or you're going to obviously, it was 19%, you're going to get less than that. And it was complete chaos. I'll come to the question about whether this has all panned out, whether we're just all being very alarmist and all our fears didn't quite pan out as we expected. But let me quickly go back to that fundamental question. A fundamental consequence of the DDEP and the crash that the economy struggled and endured is that government is having to go to the treasury bond market now as this primary market for getting money to run its affairs. And William Pepra, tell me about what this means, though, for our economy. Is that even sustainable, Prof, considering how much government is borrowing from the treasury bill market?
So, Evans, in the first place, this strategy is a mismatch. If government have a need for long-term projects, they may have to use long-term funding to pay for that kind of project. So the moment government is now using short-term financing or money market instrument or instrument that is due within 1 year to finance the country's operation, then it means that government will not be able to take on long-term projects. What government probably may be able to do is to be able to take care of current needs, current operational needs. The other side is that this brings in crowding effect. Private sector will be competing with government to get them funds, and the data has been shown by the central bank, noticing that funds or banks are not lending more to companies. They prefer to give money to go into the treasury bill instruments. So this is what is going to happen. And when
but is that sustainable, Prof?
It is not going to be sustainable. We may have to find a balance of still find a way to ensure that we have a long-term funding coming in. And that is where we need to find out how the finance minister, the finance ministry, and their team will be thinking about what can we do, though we are shut out from the external market. Are there other avenues that we'll be able to bring in long-term financing? So there are a lot of strategies that I think that government can consider. Probably as we can share ideas with them. And then they have also the men, they said it. So we want to see what they need to do to make sure that they get a long-term financing coming in. For me as an academic, I may talk about what is in the books, what has been done in the past, but they are there facing the reality. They may have to be able to come out with, they think that this will work for us, this will work for us.
Yeah.
We've noticed that government is using the taxation approach to bring in revenues, but it's also have its effect. So the ultimate aim is that, as we have all been saying, government may have to find a way to slow down on certain projects, prioritize on certain actions or projects, and use the funds to meet the needs or short-term projects. If you ask me, a project like the Agenda 111, which must be funded by long-term funding, can no more be funded using short-term financing instrument. So the government may have to go in and look at that. What can we do about them? I understand, I realize they said they are going to cut it to reduce the number, but they have already put in some monies into them, which they must have to go back and look at it. So crowding out effect is one of them. Using the short-term financing for long-term short-term funding for long-term financing of government activity is not sustainable.
And Dr. Tui Champon, I want you to look into the crystal ball a bit for me. 2025 to be more specific. Whatever pain that the economy has endured, myself and everybody else who invested, for a reason. We're told we need to sacrifice. Okay. So in 2025, if you look in the crystal ball, is this sacrifice going to yield results in the way that we can say we are out of the woods because of all the sacrifices and pain that everybody else had to endure, so that we avoid the Jamaican situation?
Contingent on a number of factors, some of which Williams and Dr. Eduanani have talked about. But the other important factor here to complete the circle is what I mentioned earlier. You have to complete the external debt restructuring, which is really, really, for me, even more important than even the domestic debt restructuring. We've also got to keep, tabs on spending cut and all of that. I think in 2024, we probably would, on the basis of the data I've seen, we're gonna be fine. But any new government that comes in 2025, you've got to restart the whole process pretty much all over again. It's going to take about 2 years for us to see the full effect of the recovery within the economy. And I say this because even when you look at the post-DDEP bonds, the government listed or sold them at around 9%, right, from 19. If you look at the interest rates now on the secondary market for all the new bonds that were sold, they are now hovering around 19%. Yeah. So it still tells you or shows you that you're only kicking the can down the road, and people still don't trust the government as much. So implicitly, they're discounting, the notes that they took. So what this is telling me, we've been able to get some short-term relief from the pain, but there are some long-term actions that we must take on the revenue front, on the spending front. But I think the most important thing now going into next year is really what happens on the external debt restructuring.
Okay, and Dr. Donanenchi, I end with you. Considering how much doom and gloom we're anticipating at the beginning of the domestic debt exchange, a year on, were those fears founded? Were we justified to be, or looking back, you say possibly we're just being alarmist?
No. We were all justified. If you were using average, let's say 20% or 19% on your bonds, and the government said it was not going to pay you any interest at all in the first year, and then subsequent years you were going to get about 5%. Increase to 5 point something until it gets to about 9, 10 over 12, 15 years. That wasn't a joke. That you are going to suffer. So even when the investors, that is the investors who are below 59 years, 59 years, have gotten even 10%. That 10%. If you are getting 19, 20, it means half of your coupon income is gone off. Half is gone off. And inflation is there staring at you. So it wasn't a joke. Even after you have gotten this 10% for individuals and 15% for pensioners who tendered in their bond, it was still not a joke because you have lost part of your coupon. And inflation was going up, and you were going down. So it wasn't a cry for just a non-existence problem that was not there. It was a real problem, and people are facing it. If you had gone for loan from a bank and were using your coupons to service that loan, you can't now service that loan with your coupons. And the bank is not going to come down on your interest. That because you were taking 90% from government bonds, and now you are taking 10%. I'm going to reduce the interest that I'm charging you. No. So the problems are there, real problems. It wasn't an imaginary problems. We are facing it, and you continue to face it.
Yeah. Okay. Good. And quick, one word: was it worth the pain? Yes or no?
Yes.
It was. Okay. Good. Thank you very much. Enjoy the rest of your evening.